Hey, what's up guys? John here. If you're a real estate investor, you want to become a real estate investor, a homeowner, and you are very, very concerned about what's happening in the economy, I'm going to lay out a game plan of what the Fed is intending to do right now that could greatly impact your ability to buy your next rental property or your first property, your first home. Now, we are entering an era of quantitative tightening, meaning the economy is going to contract. Whereas we were formerly in a quantitative easing environment where everything was, there was a lot of stimulus, a lot of money in the economy. Interest rates were very low. It was very beneficial for stock investors, for real estate investors. Everyone was making a lot of money. Now we're stepping into this new environment, except it's going to be very different. I think banks and lending institutions are going to look at risk very differently, and I think that they're going to remove a lot of their mortgage products from the open market and make things very, very challenging in the years to come. That's why if you want to make a lot of money, I believe that the chance to make a lot of money is narrowing. I think that we have a couple of years to make as much money as possible, and then after that, it's going to get very, very hard. Here's what's happening. The Fed's $2.7 trillion mortgage problem. The Fed's holding of mortgage-backed securities, MBSs, has, look at the increase from January 2008 to May 11, 2022. If you took out a mortgage over the last couple of years, there's a good chance the holder of that loan is America's central bank, a consequence of its monetary stimulus efforts throughout the pandemic. Why it matters? The Fed will face a series of political and economic headaches as it attempts to move away from subsidizing home lending by shrinking its portfolio of MBSs. The problem, extracting itself from this market, risks crashing the housing industry and creates intense political blowback for incurring financial losses. By the numbers, back in February 2020, the Fed owned roughly 1.4 trillion in mortgage-backed securities, and the number was falling rapidly. But when the pandemic took hold, the central bank began a new round of bond purchases known as quantitative easing, swelling that number to $2.7 trillion. The policy contributed to an ultra-low mortgage rates that stimulated home buying and refinancing activity until recently. Now the Fed seeks to tighten monetary policy to combat inflation. It wants to shrink that portfolio. It may turn out to be easier said than done. The Fed says that by September, it will reduce the mortgage portfolio by up to $35 billion per month, emphasis up to. In fact, the numbers will probably undershoot that. The reason for now, the Fed is just looking to let go of its holdings shrink as securities get paid off, but with mortgage rates way up in recent months, people have little incentive to sell their homes or refinance a mortgage, so these mortgages are likely to stay on the Fed's books longer. That will leave the Fed with an unappealing options. It could simply accept that they will continue to have an outsized role in the housing market and a bigger balance sheet than it might prefer, or it could begin selling the securities on the open market, a possibility that the minutes of its March policy meeting said it could happen down the road. And what they're saying, let's get the program we've got underway and up to speed. But then once we've got it underway, I think it'll be worth taking a look at what is happening to the mortgage-backed securities on our balance sheet. Thomas Barkin, president of the Federal Reserve Bank of Richmond, tells Axios, "I'm certainly open to target and disciplined way to sell in this market, and we're not headed towards a primary treasury balance sheet that we want. But yes, that will create its own problems if the Fed sells mortgage-backed securities that pay low rates at a time when prevailing rates are much higher. It will incur a big financial loss that will reduce the funds the central bank returns to the Treasury. In that scenario, expects officials to face tough questions about Capitol Hill to explain why they've lost billions of dollars on behalf of American people. Plus, the sellings would likely push mortgage rates up further at a time when housing industry is already starting to groan under the pressures of rising rates. Home builders, real estate agents, and other influential industry groups will make their unhappiness known to the elected officials. The bottom line, the Fed's pandemic actions fueled the housing boom as it tries to withdraw the support it could from bad news from housing and the Fed's capital standing, right? So, and here's how it will impact the market. When the Fed sells mortgage-backed securities, there will be buyers, including banks, insurance companies, and pension funds, says Joseph Wang, a former senior trader on the Fed's open market desk. But he notes that over the next several years, about $2 trillion in quantitative tightening is going to overlap with historically high Treasury issuance. That means a lot more supply for investors to absorb even before mortgage-backed security sales. And Wang adds, recent fund flows suggest waning demands for treasuries. Even the most Ardent bond bulls will not have enough money to absorb the flood of issuance, so prices must drop to draw new buyers, he observed. So how far will prices need to drop, and how high will yields need to rise? Then there's an impact on housing, how the Fed handles mortgage-backed securities underwriting crucial to what happens to the overall economy. The central bank must cool the housing market, which makes up 40% of consumer price inflation and a fifth of GDP. But what happens when demand slows and prices still rise because of low inventory? And finally, when central banks sell mortgage-backed securities, it's likely to do so at a significant loss. Who will eat it? Now, what's going to happen is the Fed's going to need to get rid of all of the $2 trillion. They're going to need to start liquidating $35 billion, up to $35 billion per month. Now, how is this going to play out? The buyer of these mortgage-backed securities is going to buy these mortgages, and they're not going to know the real risk that they're taking. Remember the 2007, 2008 real estate crash when they were packaging mortgage-backed securities and they didn't know if they were C grade or B grade? They didn't know. They just bought it, and a lot of banks ended up assuming massive losses. Now what's going to happen is that over the last few years, they made a ton of money because of QE, quantitative easing. So they had massive equity in their homes, stock portfolios, retirement plans. Everything was very liquid. They felt very rich on paper. But now that equity, that wealth is drying up, as well as the opportunities for small businesses in this inflationary environment where things are getting much more expensive. So what's ultimately happening is people that were qualifying for mortgages just a few years ago with ease will have a much harder time today in this new environment. So what's likely going to happen is that over the next year or two, as rates continue to rise and debt becomes harder to obtain, things are going to get much more challenging for Americans to stay in the green. So what is also going to happen is we're going to likely see more and more foreclosures, more defaults as the economy begins to contract into this quantitative tightening. So as that happens, we're going to likely see more and more defaults on these loans. And so then ultimately what could very well happen is that banks are going to see the writing on the wall, the collateral risk on the wall, and say, hey, we're seeing this economy, we're seeing all of the money that's being lost with these mortgage-backed securities, we're seeing the risk is much greater than the reward. Interest rates now have to become here, and before you know it, interest rates are very high, and it's harder to get loans. So I believe what we're likely going to see over the next couple of years is going to be a very, very big contraction of home ownership and a very big contraction of available credit. That's why I think it is so important right now to study what's going on, to have a really good game plan as to how you're going to make a lot of money, also how you're going to access good credit. So you want 720 credit score or above, and then how you're going to save money and how you're going to prepare for these upcoming turbulent times. Because without doubt, we are going to see tightening of capital. We're going to see less capital available for the general public. We're going to see banks start to, pull back on credit lines. We're going to start to see people get much more conservative with their businesses when it comes to lending money. And I almost guarantee that what's going to be different about this upcoming recession than former recessions is that former recessions, they would happen because, people would be too leveraged. People would be too optimistic about maybe dot-com bubble or real estate, or they were too optimistic. And then ultimately people are over leveraged. They go through a few years of financial pain. But what's going to be different now is that this recovery is not going to be one that is reminiscent of a history. This recovery is going to be coupled with artificial intelligence, technology, robotics. These are all going to be very, very important with the recovery. And it's going to be important because all these corporations are pushing it. Elon Musk said his new Tesla bot is going to get rid of boring and tedious tasks. Boring and tedious tasks, which is like most American jobs, most middle-class jobs. He said it's going to be bigger than his car business. So what does this mean? This means that this recovery is going to likely take out more jobs. So a lot of people that qualified for mortgages that had immense opportunity for the last many years, now we're going to have less opportunity. Now we're also going to likely see, and we're already seeing this right now, is border walls are going to basically be opened up for opportunities. So what does this mean? It means that America was once the land of opportunity, where all the opportunity was, and now what we're likely seeing is we're seeing more and more outsourcing as inflation runs rampant in America. Wages are through the roof. I'm seeing some article is that babysitters are requiring $30 per hour. Now, you still have to think of the actual real cost of what it's going to cost to hire an employee versus outsourcing. We're going to see this continue to happen over the coming few years, and this outsourcing is going to take opportunity away from America. So as this happens, we're just going to see less and less stability with American incomes. Banks are going to see that, and they're going to say, hey, this is a little risky. This is too risky for us to lend on. And I believe we're going to really start to see a big contraction in the housing market. We're going to see a big contraction with available credit, and I think we're going to see a very big change into what America sees as home ownership and realistic for people to actually obtain. The American dream of home ownership looks like it's slowly evaporating. What are your thoughts on this whole situation? Drop your comments below. Hit the like button. Subscribe here. Also subscribe to my second channel. It's going to be a podcast and an interactive show next week. Also on TikTok, LinkedIn, Instagram. Everything is in the banner. I'll catch you guys later.